Welcome to the PTA Real Estate Podcast. I'm your host John Caligiuri. A very special guest, Nick Bermeo. Welcome.
How's it going? Glad to be here.
Glad to have you. Nick is a financial consultant located in New York City, so I'm very excited to sit down with him and chit chat. For all of our listeners out there, all 12 of you, uh, wondering where Nick Kelling is, his brother is having a baby as we speak. So thoughts and prayers for him. I hope the
Mm,
pregnancy goes well.
for sure. Cool.
So Nick, can you give us a little bit of background about yourself?
Yeah, for sure. So I work at this company called MSCI as a consultant there, focusing on like our sustainability products. So a little bit more background in sense of like what MSCI is, and like what the company actually does. So essentially, MSCI stands for Morgan Stanley Capital International, and the company actually used to be part of Morgan Stanley back really in like the 90s. Like the I guess the bread and butter of the business is like index funds. So like Morgan Stanley back in like the 70s bought this or acquired this company called Capital International, which is this big index provider back in the day. Essentially, Morgan Stanley created this little like subsidiary called MSCI where they took some of their analytics products and their index fund products and they put them into this company itself. Then right before like say great financial crisis, so GFC, the company looked to say, I guess, pull capital away and to focus on more like their core banking products and index funds, really like passive index funds and such weren't like a big thing. So sold the company back in like '07, or that's when it IPO'd. And ever since then, it's one of the more like successful spin-offs that's like ever come out of, I guess, like say finance and such. So that's a little bit background of the company. It's not like a bank or like more
Yeah.
traditional finance. We have just a bunch of different types of investment products that serve, say, asset managers, hedge funds, asset owners like pension funds, sovereign wealth funds, and such. Also, real estate firms as well. So, kind of everything under the sun they service.
So you're not for the retail customer. Like if Joe Schmo off the street wanted to go and you're not offering products to them. It's more to like investment banks or
Yeah.
like other financial institutions. You're not.
Yeah, really, any big financial institution under the sun, which like a lot of the products that they do offer, MSCI does offer, is accessible to say, like you said, like a Joe Schmo or something like that. Say really like the most accessible one is like an index fund,
Yeah.
which index funds, to be honest with you don't even need to go through a bank to gain
Yeah.
access to. Some seem to like the S&P 500.
Yeah, which is kind of crazy with the advent of like technology and all the trading services. Because I didn't know this till recently. Like in the 80s and 90s, like buying index fund was like a big deal. Like now you think
Yeah.
of it like, oh, this is bread and butter of my portfolio. It's like, oh, I got a
Mhm.
couple $100. Let's just throw it in there. I didn't know it
Exactly.
was like such a big deal to like acquire one of those things back in the day.
Yeah, it's kind of crazy. Like if you turn on like CNBC or like Fox Business and such, you'll always see like S&P, Russell, Nasdaq, and the Dow. Like S&P and the Dow are technically the same thing. So
Yeah.
like the Dow 30, like traditional Dow that people talk about, 30 biggest stocks or like equity stocks within the market, and the S&P 500 is just 500 biggest stocks and such. They're technically under the same HUD.
And
Russell. Oh
correct me
yeah,
if I'm
of
wrong,
course.
the Dow and the S&P 500, do they adjust them every quarter or every year?
It depends. So at MSCI at least there's like a biannual one. I can't remember if S&P is quarter. I believe it is a quarterly basis. It's either quarterly or biannually. It's one of the two. And it's like for people who don't know, like by terms of like adjustment, it's like obviously take a super easy example like S&P 500 takes the 500 biggest stocks within the stock market. So not every single stock is going to hold the same, I guess, like market shares you can think of. So like one, say, company could be worth $500 million, it dips down to $450 million, and say like in market cap. However, there's a couple other companies that go from like say 400 to 500 within that like index rebalance. One gets pushed, like that one will get pushed out, another one will get pushed in. So it's simple as that, is like what index rebalance is.
Yeah, so basically just to summarize it for the layman, because I don't think everyone knows what a market cap is. You got the group of the 500 best companies. If companies 450 to 500 take a dump, the next man up mentality. So it's a constant
Mhm.
recycling. So it's really a good indicator of the health of the stock market and the health of the U.S. economy. Some people like to belittle that point of like, is S&P 500 really or the stock market really a good indicator of the U.S. economy? I think there's two
To a
sides of that
degree,
coin.
yeah.
Yes and no. Yeah.
Yeah, it's
So
definitely, you're like you said, yes and no for sure.
you could
You
definitely.
look like during COVID, man, it was like, what the hell's going on? Like, it's not, stuff's not okay, exactly.
Yeah.
So yeah, simple as that. Exactly.
So how did you give us a little bit about your background? How did you get
Mhm.
into that and go from there?
Yeah, for sure. So I graduated from a small liberal arts school based in Pennsylvania. It's called Bucknell University. I studied economics, like finance management, and then also like environmental studies. After school, I worked at this small like market research firm called Third Bridge, which is focused on like primary research and work with a lot of similar clients actually that MSCI works with specifically. But I was looking for a change. One of the biggest ways, and I guess I kind of a lot of people know this is like in terms of like networking, is really started reaching out to people for advice and looking at like big financial services companies. I networked with this one guy who at least gave me a little insight into like what the company was, and then when the interviews started coming around, just had to like go out on my own and sense from there. It's kind of how I got an MSCI. So at least for networking, for me, it got me through in a sense of say 500 people apply to this job. I was able to send out my resume. This guy puts the resume in front of a recruiter and then goes like, all right, take it from there. It's not going to like give you the job or anything like that, which I'm sure there's sure certain guys say like their daddy works at Goldman or something like that, where they got that job on lock. But
Yeah.
in like most, like the most common way in networking is like companies have like applicant tracking software. 500 people will apply. 25 say resumes will be like looked at by actual HR. Best way for networking, or like the easiest and most common way, is that like say you're one of those 25 because you network with someone in the company, and if the conversation goes well, you send them your resume. They'll give you that resume to the recruiter. Obviously, it's like, oh, you look a good fit. You start going through the interview process from there, and then you kind of have to take it from yourself. So it's more so like how my experience went.
Okay, so were you always interested in like finance? Like, because you said you studied economics in college. I know that's not like an easy thing to do, as well as environmental studies. Like, I'd like to know like the inside of that. Like, what was the thought process? I know you're 18 to 22, so there wasn't too much thought going into that. But
Yeah.
I would like the mindset at least.
Yeah, no, I guess for me, I was definitely like always kind of interested in finance. I just like didn't really know much about it. Like I didn't know like at the time, at least at like Bucknell economics. Like I was in like the school of like arts and sciences, and the closest there's like a business school, but it was shut off, so I wasn't able to like transfer into that once I realized like, hey, I kind of want to do something like business related, so I can't do that. So basically, everyone who wants to do something business related but it is stuck in that like school of arts and sciences goes to economics. And a lot of people can do anything from say like sales to operations. They go to finance. I have one of my buddies. He works at Stifle, a small like healthcare investment banking boutique fund. He was also an economics major, just like way smarter than me. And then I know one of my other buddies, one of my roommates now, economics guy as well, and he just works in tech sales. So like really like the major super broad. You can go where you want with it. So at the time, I kind of went to more like finance related to a degree, like not in the sense of like investment banking. I didn't take like that specific course load for economics, but I was like, all right, I want to leave myself open with some options. Once I graduated, got a job, realized I didn't like that job, and I was like, all right, let me try and figure out how to get closer to at least finance. That's when I kind of like discovered like MSCI and such. So
Because
even though it was yeah, oh yeah, what were you gonna say?
because I just had a question, like, because you said you were a consultant, but you at first you're at like a research
Like
firm.
or market research firm. I was working on like the client service team for a year, and then I
What is the
shifted to
difference
for
for like
what?
man? What's like the difference between like a consultant, an investment banker, a market research guy? If you
Mhm.
can break that down for us.
Yeah, so I guess like a consultancies to a degree are like more so I guess different. Like we're looking like there's like a couple different types of like big management consultancy. So my job is technically a consultant, but realistically I'm like a product consultant and a relationship manager. I manage relationships with say like investors, and then explain what the products are and how they can like integrate them into the portfolio. So like that's not really a typical consultant. Typically there's like management consulting and investment banking, like you said. So there's a couple different type of management consulting firms, just like the big three, or MDB as they call them. It's like McKinsey, Bain, and BCG. And then there's also like big four management consulting firms, which are really also like audit and tax. So it's like KPMG, EY, Deloitte, and then PwC. So in terms of like management consultants, I just really go in. It's not like necessarily finance related either. It's kind of its own little designation. They can go in and help, say, like financial services firms. They can go and help corporates. Could be as like something as you heard us say, like, oh, they're helping going with the restructuring, they're leading to layoffs, or oh, this company specifically doesn't have like specific resources to look at to say this market research study, and they give it and they hire a bunch of experienced consultants, and they'll pass in like what they want to do after them. They'll do the work, give it to them to like, okay, look, we're trying to do a new like go to market strategy with a product, hand off to the consultants. They look at the feasibility of it, send it back to them and say, oh, here's our example, like here's our information stuff. Here's a recommendation. You should either go for this product or go for launch this product, or no, this is horrible. This market's very saturated. Don't do that. In terms of investment banking, that's really just like I guess you can look at that as the sell side in terms of finance. So it's like in finance, I'll break it down. There's like two really big sides. There's like the sell side and the buy side in terms of selling companies and then buying companies. So investment banks are generally selling specific companies, or say like a company comes to them and they're like, okay, we're a private company and we want to IPO. So it's like an initial public offer. They want to essentially list themselves on the New York Stock Exchange, on the NASDAQ and such. So investment banks will be hired for insane fees. They'll look at the financials of this company. They'll look at the evaluations and such, and then work on, say, raising capital for more capital and such that they need to raise more capital for money in order to list themselves on the stock exchange. They also like sell for private deals too, and that's when you can kind of get into like private equity. Say, companies looking to sell themselves to a private equity firm, they'll hire an investment bank, do the same thing, look at financials and stuff of like how the company's doing, get a valuation price, and these huge private equity firms or private equity funds will then say buy said company itself. Like happens a lot within like venture capitals. Technically, private equity is just like a lower level train. Then there's like growth equity and private equity and such as well. So in a sense, that's like my long-winded answer of like what the difference between, say, a management consulting is, or they're looking to solve problems for, say, corporates or financial services, and then investment banking, which is really just at the end of the day, like selling firms. There's more to investment banking too. Like it's just like scratching the surface of it, but it's like super basic one.
That was like a perfect answer because like I kind of had like I had an idea of it of like, but you definitely filled in the holes for me of
Cool.
the difference of it. I'm just wondering like in that big overarch of like
What they're doing.
very broad strokes of New York finance and stuff like that. Where does your company fit in that? Like, what would you say your company does the best?
So my company is what's called a fintech. So it's like financial technology. Basically, you can look at like MSCI or like S&P or Russell or London Stock Exchange, the NASDAQ. I say like a plumbing of the financial world. So we have all these different types of like, yeah, exactly. So we have all these different types of investment products that we sell to banks, big asset managers such as banks such as like JP Morgan, Bank of America, and then also really small banks as well, like retail, like local banks. And then to say like big asset managers, like scary ones like BlackRock, State Street, Vanguard. We can go into more of that too as well. Say big hedge funds, so like 0.72 and such, all the way down to say corporates. A lot for like at least when you're selling to like at least for MSCI's bread and butter is like asset managers and then asset owners. Asset managers, like I said before, like BlackRock and State Street, and then asset owners, which are really just like asset managers manage asset owners like capital. Technically, to a degree, you and me having say like $20 together, we're like an asset owner, whatever. But really, when you're looking at asset owners, you're looking at like pension funds, sovereign wealth funds, foundations, endowments at schools. Like those are like the asset owners. Even to a degree, insurance companies are asset owners, but they kind of have their own segment. They're looked at as insurance funds or like insurance.
So correct me if I'm wrong. How I understand like an asset owner that like would be advantageous, like would be your style customer, anyone who has like large like cash reserves or like capital reserves. Like it could be like they have like large 401k from their large 401k pension, or they have a lot of cash reserves.
Exactly. Like you can look at any like the big pension funds across the US. So like NYSERS, like New York City Employment Retirement System, or CalSTRS, like the California. I think California retirement system such, they both have like, I don't know, 250 billion to 300 billion in AUM. So in assets under management. So at least for in the
For
pension.
the
Yeah.
listener, especially for the people out there, I don't think because I realize I just realized this recently. Like, say you're not even you have like a 9 to 5 job that has a pension, and they get
Mhm.
you're like, I'm gonna do my 30 years and retire.
Of
What
course.
companies do? Say you work for company A, and you have a pension with them. What they take every month when they take or every paycheck when they take money out and put into your pension fund, that just doesn't just sit in a bank account and collect no interest. They take that large sum of money and go to companies
Mhm.
like Nix or State Streets or BlackRock, Vanguard, and then they invest it for them. Just for the lay person out there, like so people know the background, what's going on with their money.
Yeah, so it's like my stepdad was a firefighter for like 25 years. So like he has a pension fund now for X amount of years for into the future. And the reason why that money exists is because say and like a pension fund who then gave their money to an asset manager to, invest and get significant amount of returns and able to give back to the pension owner specifically to have that money for the future itself. But yeah, so that, I would say that would be like the bread and butter clients. Asset managers, asset owners are like the biggest clients. Banks are also to degree, and then also hedge funds as well, and then insurance firms too. Like there's a lot of different types of like these products. So like I guess the most basic product you can look at is like index funds. So that's where like MSCI started, and really it's the money maker today. Like in terms, I guess numbers. So there's like there's really three index providers that like kind of dominate the market. So it's S&P, which is also the Dow, MSCI, and then the Russell, like Russell, like FTSE, which also there's also like in time to like the London Stock Exchange and such. Nasdaq is also big, but they're not as big as people think. They just do really good marketing and advertising and such. So in terms of like the numbers behind everything, so an S&P, and not just including like S&P 500, which most people know or hear about. Like S&P has thousands of different types of index funds. There could be the S&P 1500, there could be S&P 50. There's also like the S&P 7, which are like the 7 biggest stocks in the S&P 500, which is basically just like what you would think Apple, Microsoft, Meta, and those kind of companies and such. So there's like trillions of dollars following these index funds. S&P has like 15 trillion. MSCI has like 14, like 14 and a half. Russell has like, I think 13.7. And then NASDAQ has like 12 trillion. And by like following money, I mean like benchmarked against. So in terms of finance for like asset managers and like for these parts of banks that like manage assets as well, like JP Morgan, Goldman, they all have like their asset management divisions. You need to essentially in today's day and age, because it just doesn't make sense, you need to have like a benchmark against like an index. So there's like active investing and then passive investing. Active investing was big in the past in terms of like people just trying to beat the market themselves, creating these portfolios. Like you can look at it as like day trading and such, or really just like a retail investor like you and me who's not benchmarking against anything. I'm like, oh, I'm going to buy GameStop and I'm going to follow it to the moon or whatever. Exactly. But then there's the more traditional and passive investing. Exactly. So passive investing started getting really big, I guess, to a degree after great financial crisis, and really within like that 10-year bull market we had up until COVID, really grew from there. So passive investing essentially is just like, say, like a financial institution like BlackRock, they basically will follow, or they have a mandate to follow against the S&P 500. So they'll create a portfolio that consists of the exact same 500 stocks against the S&P 500, and they let it ride. They'll like maybe tweak themselves sometimes, but depending on the mandate they have from whoever's giving them the money to invest, like it's going to be following that. So you can be a benchmark investor where you're passive and you're literally just following an index or an ETF as what the S&P 500 is. Or you could say which is just passive investing, or active investing, which is like you're benchmarking still. You have to benchmark in order like to be a serious player. You have to benchmark against a provider, but you're trying to beat that said benchmark and such. Like everyone is trying to beat the benchmark to say like, oh, look, we know what we're doing. Like we beat the S&P 500 by 2.5% this year. S&P 500 grew by 7. Like I'm just giving an example, like 7% within last year. We grew by 9.5%. We benchmarked against S&P 500. Give us your money. We'll invest it for you and make it back. So no, another long-winded answer, but index funds are huge. You can't be a serious player and not, at least within asset management and like managing assets and such, you can't be a serious player and not have it, or else basically those asset owners, like those pension funds, endowments, foundations, sovereign wealth funds, they won't give you money. So I'll backtrack a little bit. So I think I spoke about, or I brought up mandates to a
Yeah.
degree, and like essentially all these asset managers are competing for this capital from these pension funds, endowments, and such. So these guys will put out like a mandate. So let's say like New York City employment retirement system has like a $50 billion fund that is, say, the teachers retirement system. So it's like they'll have different subsets, like sub segments. So there's like fire and police, there's teachers, there's regular federal employees and such, all these funds. So let's say like the teachers is like a $50 billion fund, and they're gonna let, which, and the reason why they do this is because like state-run organizations are so underfunded that they just can't do it themselves. Like there are a lot of smart people work at pension funds, like way smarter than me. However, it's just like they're very underfunded, and the reason why like asset management exists is because it's like the private sector. It's where majority of like this like very intelligent people in finance go. So
And also someone
yeah,
I've worked in the government before,
mhm,
like, it just, like, the nature of it, like, you're
exactly.
not a money-making organization, you're
No.
a service-providing organization, so just, like, the nature
Mhm.
of the beast, like, I'm sure I've met some of the smartest people I've ever met in my entire life was in the government, and the biggest dunces I've ever met were in the government. It's like, the nature
Exactly, man.
of being a service
Exactly.
industry, not a money-making organization.
Yeah, exactly. So it's like these pension funds, in order to get like better returns for, say, they're like pension holders and such, they will outsource to asset managers. So they'll put it on mandate. So say out of this like $50 billion fund they have, they're gonna let an asset manager manage $20 billion of it. So they'll put out a mandate. So let's say, I'll just give like I guess the three examples of people everyone will know, like BlackRock, State Street, and Vanguard, and they'll put them all together, and they'll give them this mandate. And essentially, they'll be like, hey, here's what our requirements are for you to manage these funds. If you don't, like, say, meet these requirements, we won't let you manage this $20 billion portfolio, or out of our $50 billion portfolio. And those include, you need to benchmark against, say, like, might just be like you need to benchmark against MSCI ACWI, which ACWI is MSCI's big version of, say, like S&P 500. So it stands for All Country World Index. It includes, instead of the S&P 500, which includes, say, like the 500 biggest stocks in the U.S., ACWI gives you exposure to like the entire world. So say it'll be like 100 biggest stocks in the U.S., 20 biggest stocks in Europe, 30 biggest stocks in Asia, 50 biggest stocks, say, in another part of Europe, so like Western markets and stuff, part of China as well. It gives you exposure to the entire world, so it's much more diversified and less risk than, say, just investing in the U.S. market, which, as we hope, is not going to crash. But, as we've seen in the past, COVID, financial crisis, if you're invested strictly in the U.S., like you could be screwed momentarily.
And
So
and I
that's the
just
reason
word on
why.
the street, you ever heard the term "scare money, don't make no money"? There's a lot of
Yeah.
scared people not out there. Like, as a
Hmm.
retail banker right now, I am handling a lot of questions from just, like, the regular Joes on the street. There's not very much confidence in the US market. I don't think it's gonna crash. I don't wanna say it's gonna crash and be a
They
voice of doom.
might, could trade
It's really
sideways for who knows
so
how
yeah,
long.
yeah.
Exactly. Like we don't, a lot. It's sad, but I guess it stinks that we couldn't have grown up within that 10-year bull market where so much money was made, and you
Yeah,
kind of realize like, oh wait, yeah, we really missed out on that. Like, damn. I mean,
yeah.
we were kids into teenagers and young adults, but I didn't realize it. I don't think a lot of people. I think people just thought it was going to go up forever, after financial crisis and such. But yeah, so I'm getting sidetracked. So like they'll put out these mandates, say you got to benchmark against this specific index, and then if you don't benchmark against the index, we're not going to give you the money. So say they were like, you got to benchmark against ACWI. We like ACWI in terms of like their risk averseness, in terms of like they're invested all over the world, or at least the index is specifically. So go out, buy that specific index, benchmark against it, and then come back to us. And then the way that indexes work is that, or at least like MSCI, Russell, S&P will make money is based on like asset-based fees. So say like an asset manager comes to us and they're like, all right, we have this fund, say it's like $1 million or $20 billion. They'll come to us and we're gonna benchmark against this index, and they have to tell us how much money is essentially being benchmarked. So generally there'll be a 1% fee or 2% fee on the index. So they're allowed to go back to the asset owner or like say pension fund and say we purchased MSCI's like index equity and we're going to benchmark against it. So the way MSCI makes money is based off the percentage of how big that portfolio is. So say if it's like $1 million, it's not really 1%, or it could be like 1%. So they have $1 million fund, they benchmark against this index. 1% of $1 million is how much MSCI will get paid specifically based on the index. So say if it's like a $20 billion fund or whatever, and our asset-based fee is 1%, they'll make 1% off of that, like say 20%, like $20 billion fund, which generally that's not how big the funds are, though. They're generally much more, like could be like a couple million, sometimes even a couple $100 million and such. But like we charge a percent or an asset-based fees, they call them, on so like, okay, if you're going to benchmark against us, here you go. Like this is how much it's going to cost. This is the percent of the fee.
Do you get like the top two from the investing? So like if someone wants to benchmark against you, and do you, because you don't invest like you guys don't go out to pension funds or anything that invest the money for them. You're strictly a benchmark.
No. So we're like very much a benchmark. So we create an index like what based on what we think. So like ACWI, like I said, we'll have like 100 biggest stocks. There's like tens of thousands of index created. There's also like custom indices that say like a client comes to us and like, we have a benchmark against you, but we want to create it ourselves. Can we have say like the 50 biggest stocks in the US, 20 biggest stocks in Canada? We rate it a certain way. So like 50% of the index is going to be here, 20% of the index is going to be here. Or if you can go to strictly US, say like we want 50% in large cap, 50% or 20% in mid cap, and then 30% in small cap. And that's just like based on market cap. Like there's an arbitrary number of like what like counts for small cap, mid cap, and large cap based on like say 500 million in like in market cap to $1 billion in market cap to say 2 billion in market cap and above. Could be like large cap, mid cap, and small cap and such. So there's always like crazy different terms. So there could be like ACWI excluded US. So it would be like ACWI, or the most common one, and it makes sense, is like ACWI X China. So it includes everything in ACWI or the All Country World Index, but you take out anything that is within China specifically, just because
is it
China to a degree. There's a lot going on between the US and China right now, especially within the markets and especially the US. So it's like you can't be invested in anything in China. So just take every Chinese stock that ACWI could be invested in, and they'll just take it out of the index itself. So that's called ACWI X China. So
on
that's
China.
like a very common one.
Is it because of our poor political relationships with them, or because a lot of people don't know, but China's going through their own '08 versus like real estate right now?
Real estate, exactly.
I think what their biggest real estate firm, they missed like a $20 million debt payment. And that's like basically saying like Apple missing a $20 million debt payment. They have $20 million in cash they could throw off a volcano in Hawaii. Like it was a very big deal for someone like I forget the name of the company, but I know China's going through their own like real estate. They had their bubble, and now they haven't crashed yet, but it's not looking good because what China did that was different than America, which is very interesting.
Like
is that
local debt too? Their like local debt is insane, and that's because of like real estate and such. Yeah, sorry, no cutting off, but that's like one of the big differences is that their debt to GDP ratio is roughly the same for the US, like the US is, but their local debt's insane in terms
because
of like
how they go about building a house. You have to
exactly
the money to the house before it's even built. So all those real estate firms just took them. Some might say money laundering, but they just took them. They just took the money, and now it's no longer there. And a lot of billionaires were made. So it's very fishy in there for sure. So I can see why you want to exclude China.
I could say that's a reason, and then also like politically is a reason. There's like governments like, we don't want you investing in China and propping them up further than what they already are. There's been like probes into that already in terms of like for asset managers and index providers. So we'll be like, all right, create the index without China. And that's why it's actually China. Like you can still, at the end of the day, invest in China. There's just a lot of scrutiny that goes like, oh, like you're propping up the Chinese economy with American dollars. Like, why are you doing this?
Yeah.
So, but at the end of the day, you can explain to what's like, well, you got to be, kind of, if you're like a huge player, you got to be invested everywhere because, what if the US stock market just crashes again and we lose everything? Like that's one of the reasons why these globalized investing kind of exists. It's kind of crazy. So yeah, it'll be like a typical index fund that exists. So then I guess, straying from you were going to say something, John, my bad.
I was going to say just with globalization, if like kind of like agreeing with your point of like, if you're a global player and with globalization, like think about it now, I have a Mac right now and I use an iPhone and I'm speaking on a microphone. I'm
Mhm.
gonna gander say out of those 3 items, at least 2 of them minimum were made in China. So like
Yeah.
it's hard even as a consumer to sit on your high horse when majority of your day-to-day progress comes from products, not progress. Majority of your day-to-day products come through Southeast Asia. Because I know
Yeah,
like
exactly.
now China's like the workforce is getting older and stuff like that. And now Taiwan and
Yeah.
Vietnam will kind of make an explosion and stuff like
Even
that. But
India too. It's crazy.
oh yeah, I think India is our number one threat. Like not to go political, but like just on the sheer fact of India is a has 1 billion people. Their population is significantly younger than China because they didn't have the one
Yeah.
child ban. They hold a
Mhm.
lot of water, like they have a lot of natural resources, and just like their beef with the West. So like they because like the problem with China is they don't have the Western processes and procedures to like
Whereas
grow
like
and create
India
their
does.
own things. Like
Yeah.
India was a British colony, the English say what you want to say about America and what we did to the Native Americans. Like the British literally starved and enslaved the Indian population so badly that now that they're being more industrialized, that their bodies hold on fat longer, and I think they're the 2 or 3 in obesity. America's still number one, hoorah, obesity, but I think they're 2 or 3 now just because their body holds on fat because English enslaved them and starved them for so long. So
Yeah, that makes
I
sense. That's
think
crazy.
I'm not really scared about China. One, because like like their real estate portfolio sucks. Two, their population is aging, and three, they don't have the Western process and procedures. Like all their tech is just stolen Western tech that they just made into themselves.
Yeah. And that's like you can say like China too, the same. Or I don't know if you were even talking about China there, but yeah.
Yeah,
And
I
it's
was
like
talking.
India's crazy too because they play both sides. Like they like buy and sell natural resources from China, but then they'll also like work. They're much closer with the West than say China or Russia are. So
Yeah, and
yeah, and
also,
who knows, man? Who knows what could happen with India? You never know in the next 20 years. I mean, China
yeah,
basically blew up within 20 years.
yeah.
Like 20 years ago, it was nothing, and then now they're like the backbone of the manufacturing economy in the world. So it's crazy.
Who knows? All those 7-Eleven owners might be sleeper cells for India.
Exactly, man. Exactly. Yeah. Um, outside. What was it? Oh yeah, I was talking about mandates. So, and construction of indexes. So I'll finish up that example super quick. So it's like say whoever say buys that index first, and then there's also like way more than just say like buying an index. Like you have to be invested specifically in renewables. You have to be invested within oil and gas in order to get the specific money from like pension fund and stuff. And then whoever wins that mandate will then get $20 billion to manage from there. There's also just like asset managers manage anything like under the sun. It's like looking at like BlackRock, Vanguard, and State Street as well. They don't really control as much as what people say in social media. Like that's a lot of BS. Like what Patrick Bet David said on Rogan. Like I'm sorry, that is a lie
What
about
concerns
BlackRock
me
controlling the world. But
about them is like how they own it, like State Street, BlackRock, how they own a part of each other. Like that is what like when you talk about like antitrust laws and stuff like that, because like obviously I work for PNC Bank. I'm not anti-banker. I'm not
yeah,
anti-investment at all.
exactly.
What just concerns me is that you're getting into a weird territory. Like, are you really your own company, or
I can see
because like
that.
the mutual benefit, like if you own, like if me and you were in, say we owned 2 different gas stations, but you owned 30% of mine, I own 30% of yours, then we
Mhm.
really are 2 separate gas stations. You know what I'm saying? Like it'd definitely
See
be
what you say
advantageous
there.
for us to set price, like set the gas prices. Oh, you're selling a monster for $2. I'll sell for $2 as well. That's like really the
Mhm.
only like my only gripe with them is that the intermingling I'm just not a fan of as like
Yeah,
a pure market capitalist person. I claim to be, but like that's like my own. I don't really 100% agree with Patrick Bet David, but like I do think he brings up some points of like
the intermingling is
yeah,
interesting. But that's mainly in funds. That's mainly in funds that they're investing in, just because they need like sometimes they don't have like the people or the personnel to manage. Like I know I say like pension funds and endowments and such are all like underfunded, and to a degree, these asset managers don't even have as many people as you think. And especially like one manager could have just like way better returns than the other, and it just makes sense for like say Vanguard to invest within a fund for BlackRock as well. And it is diversification, which is huge within finance. I also see how like there's both sides to say like I don't know if you should be able to do that, but To a degree, I see what you mean. When it goes down to like shareholder rights and such, they can't, like, that intermingling doesn't work that way in terms of like voting for what can and cannot happen within like shareholders. It's say like majority of the companies that say BlackRock, State Street, and Vanguard will have like a percentage of ownership will be anywhere from like 5 to 10%, and they can't all really. They can't collude together to control say what a board says, and even then they don't even have a lot of those shareholder rights. So say like I think BlackRock owns like say 7% of Apple,
Yeah.
and realistically, they don't actually have 7% control over shareholder rights because a lot of what BlackRock invests in, it's over like 60% is in within index funds. So and just like ETFs.
But
So
correct me
within those, yeah,
with like the influence over you saying that they don't have like shareholder rights. But this is just a pure question. Tell me if I'm
mhm.
being an idiot with this. Like, say they own 7% of Apple and they don't technically have influence, but if I work for BlackRock and Apple's doing something I don't agree with, if I go, hey, I own 7%, I can liquid. I'm BlackRock. I have trillions of dollars under management, and you're doing something I don't agree with. Let me just liquidate 3% of it and tank your stock price right at the end of the quarter or this. Like, what could they do that theoretically to do input? I know that's
Yeah,
black,
I
but
get
like
me.
on the golf course, you have a couple cockatiels, and next thing you know, you say something to influence someone.
So no, they can't do that. And
Okay.
the reason why is because so like what I mentioned before, so like over 60% of BlackRock and what they're investing within like their $9 trillion AUM is within index funds. And the reason why they're investing in those index funds is because of client mandates. So say Apple, like BlackRock has owned 7% of Apple. They might not want to own 7% of Apple, but based on who they're benchmarking against for an index, they have to. And in order to keep that capital from, say, another client, like that $50 billion from, say, that client, they have to be invested in Apple. If they pull out that money, they lose all that money. Their client will be like, we're going to go find someone else. You're like, get bent. That's basically what they'll
Yeah.
say. It's against the mandate. And these mandates are like legal documents. Say like, I'm giving you $20 billion to invest. If you break the mandate from based on like the specifications where you can and cannot, you can't manage our money anymore. So yes, theoretically, it's like people think that could happen. Like I own 7% of Apple. What if I just liquidate 4% of it? You have to do whatever I say. I can tank the stock, like the actual stock price, like right before say earnings. They can't do that at all. And the reason because of that is because of index, like passive investing, and then also client mandates that they have from other clients. Like Apple or BlackRock manages $9 trillion, or it's like close to even. I think it's like 9.5, 9.4, but they're not actually worth that much. They're worth like I think 120 billion, and the reason why is because it's not their money. They're managing clients' money. Like they're to a degree they do have some control over the money, but if you do something your client doesn't want, doesn't matter if you're BlackRock, they'll just take it out, and it happens all the time. You can look at like their 10Ks and such. You can look at like client like outflows versus client inflows, and generally over time the inflows have obviously outmatched the outflows. But there's plenty of times where people are like, I don't like what you're doing, or I don't like, oh, you're going to liquidate my account. Yeah, it's done. I'm done. I'm taking all that money and it's gone. It's gone. Get screwed. I don't care. So yeah, you think you can do that, but you can't do that, which kind of defeats that argument to a degree. And that's really because of like mandates in the next ones.
No, that makes a lot of sense. I was just as someone as a
Yeah.
retail banker, very low
Mhm.
on the totem pole of finance. I just want to clarify that because
I gotcha.
I think a lot of people have seen that Patrick Bet David interview when he was roasting State Street and BlackRock, and I think he has a little. There's a vein of truth in there, but I think it was definitely dramatic.
Yeah. I mean, yeah, it was a little dramatic. I think he might be doing it for clicks too, to be honest with you,
Oh
man.
yeah. Well,
It's either that,
he knew his audience.
yeah. I mean, it's either he's like beyond stupid, which I don't think he is. And like, I mean, look at like Twitter or X engagement now. Like, the more engagement you get, the more money you get paid from advertisers and Twitter money. So you just go on Twitter and you see all those things like you reading like end wokeness
Yeah.
and all that stuff. And you're like, oh damn. So it's like, I mean, to a degree, you're right. Like you said, what he says is right and can be concerning, especially like the intermingling. But just threatening companies like we're going to pull this away if you don't do what we
That was
say,
an extreme
they can't
example
do
as
that.
well.
Yeah. No, but it's a very common example. I get what you mean. So you can't technically do that at
Yeah.
the end of the day.
And I'm Patrick Bet David. I think I'm a fan of him for sure, but I do think he's going through his like political phase. So that
Yeah,
whole rant
very
was
political.
to stir the pot a little bit and get some people on his side.
Yeah, man. 2024 should be a crazy year.
Oh, for sure. I think
We're all good.
3 minutes now. Do you have anything else
Yeah.
you want to add? Because like Nick, this truly has been fun talking to you.
For
Really,
sure, man.
I really feel educated on. So I appreciate you for your
No,
time.
it's great to talk to you. I love it.
Is there anything you want to add?
Yeah, about to say I guess that's about it on my end, man. About to say.
Awesome. Thank you for your time.
Sure, brother.
Thank you for listening to PTA Real Estate Podcast. God bless. Have a good rest of your day.
Have a great one.